Okay, so if you've been watching the Bitcoin charts lately, you've probably felt it too, right? Something just feels off. The price is just stuck, kind of grinding sideways in a way that doesn't feel natural at all. Well, guess what? You're not imagining it. We've been digging into the data, and it looks like there's a powerful, kind of hidden force that's literally pinning the price. So let's unpack what's really going on with Bitcoin's weird price action. Yeah, this is the big question, isn't it? Why has Bitcoin's price felt so weirdly stuck? You see these rallies and they just fizzle out. Then the dips get bought up almost instantly. There's just no real direction, no momentum. It's almost like the market is trapped. So what in the world is going on behind the scenes? And this quote just nails it. This doesn't feel like a normal pullback. It doesn't feel random. That's exactly it. This isn't the usual chaotic, up and down price discovery we're all used to with crypto. It feels deliberate, almost manufactured. But, and this is important, this isn't some conspiracy theory. Nope, this is all about cold, hard market mechanics. All right, so if it's not random, then what is it? We're going to follow the trail here, and it leads straight to what you could call a massive $23 billion financial wall that's pinning the price down. And this trail points to a very specific group of players who have a very powerful reason to keep Bitcoin exactly where it is. And here they are. The source points the finger directly at one group, institutional options dealers. Now, who are these guys? Well, think of them as the big financial players, the house, if you will, who are selling options contracts. You know, those bets on where Bitcoin's price will go in the future. And it's what they're doing to protect their own profits that's having this huge knock-on effect on the entire market. And the scale of this is just staggering. We are talking about $23 billion with a B. That's the value of Bitcoin options contracts all set to expire on one single day, December 26th. To put that into perspective for you, that's over 1% of Bitcoin's entire market cap, all wrapped up in this one single event. It's massive. Okay, and here's where it gets really interesting. This is kind of the smoking gun. The market is overwhelmingly bullish. You've got almost 3 times as many call options, which are basically bets the price will go up, as you have put options, which are bets it'll go down. Now, logically, all that bullishness should be pushing the price higher, but it's not. So what gives? Well, it all comes down to the dealer's incentive. And that incentive has a name, max pain. It's a key concept here. Max pain is the exact price point where the largest number of those options contracts expire completely worthless. So it's maximum pain for all the people who bought the options, right? But it's maximum profit for the dealers who sold them. And the source points to a specific number for this, $96,000. That gives these dealers a huge, huge reason to keep the market pinned right around that price. Okay, so you're probably wondering, how do they actually do that? I mean, how can a group of dealers really trap the price of a trillion-dollar asset like Bitcoin? Well, there's a specific market mechanism for it, and it's known as the gamma cage. Now, to understand this cage, we've got to talk about something called gamma. I know it sounds a little technical, but stick with me, it's pretty straightforward. In simple terms, gamma is the thing that tells these options dealers how much Bitcoin they need to buy or sell to keep their own bets safe and their books balanced. See, when they sell tons of contracts, betting the price will go up, they can't just sit there and hope for the best. They have to constantly adjust their own holdings so they don't get wrecked if those bets actually pay off. Think of gamma as their instruction manual for making those adjustments. And you know what? The source has a perfect analogy to make this super clear. Imagine you're running a lemonade stand, and you make a crazy promise to all the kids in the neighborhood. You'll give them free lemonade if the price of lemons goes through the roof. So, what happens when the price of lemons starts to creep up? Well, to protect yourself from going broke, you have to keep buying more and more lemons to cover that promise, right? That constant, frantic buying you're doing as the price rises? That is basically gamma hedging. Okay, so now let's apply that same idea back to Bitcoin. To hedge their absolutely massive options positions, these dealers are forced to do the opposite of what you'd think. They sell into rallies to lock in profits and buy into dips to cover their downside. It's this constant counter pressure, this buying and selling against the trend that creates the gamma cage. It just soaks up all the volatility and traps the price in a super narrow range. But, and this is the really important parts, this entire market structure, this whole gamma cage thing, it has an expiration date. And that date is coming up fast, December 26th. That's the day the cage door is set to swing wide open. So let's look at the before and after here.
Right now, before December 26th, the dealers are literally forced to suppress the price to manage their risk. It's just part of their business model. But after December 26th, poof, all those options expire, and their incentive to keep the price down just vanishes. It's gone. The force that's been holding this market in a headlock is suddenly removed. And I can't overstate how huge this is. 67%. This one single event is going to wipe 67% of the entire derivatives board clean. It's like a massive reset button for the whole market, completely erasing the very positions that have been dictating the price action for weeks and weeks.
So what happens when that cage door finally swings open? What happens when the biggest players in the game no longer have any reason to suppress volatility? Well, let's take a look at the source's prediction for what might be just around the corner.
Okay, so here's the forecast. First, obviously the dealer suppression just stops, gone. Second, all that volatility that's been artificially squashed down is expected to come roaring back into the market. And third, the price itself could snap back, kind of like a stretched rubber band that's finally been let go. This could all lead to some really aggressive, big moves heading into January. So where does that rubber band snap to? Well, the analysis points toward a specific destination, Bitcoin's mathematical fair value, which based on its long-term power law trend sits at around $118,000. The theory is, once that artificial downward pressure is gone, the market's natural gravity could pull the price right back toward that level. Now look, nothing in crypto is ever guaranteed. We all know that. But the market mechanics here, they present a really compelling case for a pretty dramatic shift. You have this massive pinning force that's about to just vanish, and the market feels like a coiled spring ready to be released. So the ultimate question is this: will December 26th be the catalyst that sends Bitcoin soaring back over $100,000? We are definitely going to be watching to find out.